mortgage advisor and estate agent in a room, I think we might talk about property.
It's the worst that could happen.
Yeah, anything could happen. Let's talk about affordability. I think it's a good thing to talk about because it's topic of the market. Obviously, we've had the stamp duty thing, so people are paying more tax now. Interest rates are different now than where they were 6 months ago. They'll probably be different again in 6 months' time. But affordability is something that me and you have been talking quite a lot. For people that are looking to sell, this will impact their buyers, and for people looking to buy, it will impact the amount they can buy at. So what's the general sort of trend with lenders at the moment on that subject, Tom?
Yeah, well, I think definitely the rates coming down is helping lenders sort of free up a bit of affordability. And what a lot of them nationwide, in Halifax, for example, started off offering higher affordability to first-time buyers if they're fixing for a longer period of time. But what a lot of lenders started doing now is effectively reducing their stress testing. Mm-hmm. So it doesn't necessarily mean that they're just lending X amount more per £10,000 salary, for example. But what it does mean is if you've got a car loan for, say, £350 a month, that could have potentially way less effect now going forward on your mortgage application than it might have done before.
Okay.
So I had an example of this literally last week where we had to redo someone's mortgage application. The new application was done under the new stress testing rules, and it actually increased their affordability by £40,000, which the reason we were doing a new application is because the first purchase fell through. They then actually found a property which they thought was out their budget, but the extra 40k got it over the line. So they were really, really happy with that. And nothing had changed in their circumstances except they had a car loan and a bit on credit card finance, which was affecting it more before, but now is not affecting it quite as much. Mm-hmm. So that's what we mean by stress testing, and when the lenders are kind of being a bit more free on that sort of thing. You know,
explain stress testing just in kind of layman's terms for anyone that doesn't understand what that is that the lender's actually looking at. What are they actually looking at in sort of fundamental detail?
They're basically building a risk profile, which is why they'll lend a lot more on a 5-year fixed rate basis most of the time, because they think that over time there's less risk over a 5-year fixed rate than a 2-year. But it's basically what they're doing in the background to assess what is affecting someone's finances. If you've got no loans, no debts whatsoever, no children, you're a much safer bet just in general than someone who's got 3 kids, they're paying £1,000 a month childcare, probably more. Got a car on finance of £500 a month and £5,000 on credit card debt, which is a very, very normal case that we'll see. They'll obviously see that as a slightly higher risk application because there's more debt and potentially more appetite to take out more debt. But what they're just now doing is realising actually the rates are coming down, monthly payments are coming down in general. We can have a bit more leeway now with those other debts, because when rates are at sort of like 5.5%, 6%, it obviously was making a massive difference on everyone's bottom line. So all of a sudden a 10 grand credit card is not quite having the same effect on people as it was 2 years ago, for example.
Yeah.
So it's risk profile basically.
So if I earn say 80 grand a year, but I had 20 grand's worth of debt, the calculation 6 months ago to how much a bank would be happy to lend me is different now to what it was before. Whereas they may have just gone, right, well, we'll take the whole debt off and say, actually, you earn 60 grand a year. Mm-hmm. Whereas maybe now that's a little bit of a different calculation, is it?
Yeah, pretty much. So it's not just the case of some lenders will lend 4.5 times to self-employed applicants. That, in a nutshell, hasn't exactly changed. It's more if someone's earns 80 grand but has a car for £300 a month or doesn't have a car for it, there's almost no difference now, whereas before that car loan was making quite a lot of difference. And also in terms of how long we do the mortgage term for isn't quite affecting it as much. So before, if we stretched the term, and we're going to come on to this, but if we stretch the term out, say 35 years, we could borrow quite a lot more than on a 25-year term, whereas that gap is now closing, which is giving borrowers a lot more choice in what term they go for, whereas that was being dictated by lenders a little bit previously.
Okay, so buying power for most buyers is much stronger now.
Definitely.
From affordability, so they can potentially get a bigger mortgage if they wanted to, which is a great summary.
Yeah, definitely.
We'll come back to the fixed term later in the video as well, but let's go on to the headline rates. I'm always interested to know what the clickbait is versus the real kind of actually when you do the search on all of the different lenders that you can see for a client, what is
actually available? Yeah.
Are there better rates now across the board than there were 1st of January, would you say?
Yeah, definitely.
Okay, that's
definitely.
Good.
Sub 4% rates now are very normal for sort of 60 to 75% loan to value. We had a little sort of taste of that for about a month last year, but now that has been steady for about, I'd say 3 months now. Answering your question about the headline sort of rate thing, for example, today, I don't know what date it is today, was it 5th of May, 6th of May? The lowest rate out there is 3.88%, but the sort of caveat to that, it has to be what's called a green mortgage application, which is basically a property that's got A or B EPC rating.
Probably a new build, really.
Yeah, at least been built in probably the last sort of 5-6 years.
Yeah.
So that's, people see that and go, that's great. Oh, but unfortunately it doesn't apply to me because I'm buying a property that's got a C or D rating. So those headline rates, you always get that. But what I just looked into a little bit deeper this morning, the next best rate was a 0.02% higher for any property with a different lender, and that was at like 3.9%. So that's on 2-year and 5-year as well now. So before this was only on 5 years, and I've mentioned it in a few posts that we've done with Mortgage Tribe recently. But for the first time, I think since October 2022, there's now 2-year fixed rates available that lower than 5-year fixed rate, which was always the norm for a long, long time. It was only post sort of the 2022, 2023 sort of economy where all of a sudden we were getting lower rates at 5%, because you normally paid extra for longer term stability, a bit of peace of mind. Whereas now we seem to be getting back to that, which I think is the right thing for the client actually, rather than I want to be able to review my options sooner, but I'm going to have to pay the privilege to do that. I think it is more fair to be like, actually, I can lock this in 5 years for you. It's going to cost you 20 quid extra a month, but are you happy with that peace of mind? And most people will say yes.
Yeah, giving me PTSD when I did my remortgage and had 1.54, but I could have gone for the 2.1 10-year fixed. I was like, no, that sounds way too expensive.
Yeah.
And now you look back, it's like, So, okay, that's interesting. I mean, I always do find that when we're talking to buyers, at Avocado, and we're trying to help sellers, and we're trying to put viewings together and negotiate offers, etc., for the clients, that you do see like a classic, I can say it, you can't probably, but you can see a classic HSBC kind of clickbait headline, and they kind of look at that and they go through all of the application, realise it's never quite what it is. But to know that over the last 3 months, rates are better than they were 3 months before that just gives confidence to buyers and sellers, really.
And there's a domino effect to it, because once, I think the two lenders were HSBC and Santander, they were the first to go sub 4%. Now there's literally about 6 or 7 lenders who are doing that. So, it's a very competitive business, mortgages, and if they see that one lender's going to go, it will have a big effect on the others. So it's great news for borrowers.
Yeah, and for me, again, it's, as an estate agent in property helping buyers and sellers, it's why I do think that for those buyers that are actively out there viewing at the moment, that have only gone direct to their bank, do speak to someone like a Tom, because you want to get that information, and you can't just know that information unless you're talking to a broker that's got access to a big sort of batch of lenders. Start of the video, we were talking about fixed terms, and this is always something that's interesting me, because when I first got on the property ladder, I think I got on the property ladder in 2007, the norm was just everyone got a 25-year fixed. And then it seems like over the last decade in particular, the kind of norm is more like 35 years. But let's just talk about fixed terms, cans and can'ts for people that are watching and listening. What is the fixed term, first and foremost?
So the fixed term usually is referring to the product term, which would be anywhere between 2 and 5 years typically. Yeah. Sometimes 10 years. But the mortgage term is referring to the full term of the whole loan, which, like you said, when I first started doing mortgages, it was always 25 years. Just that was the way it was, really. Yeah. Now the FCA and our sort of mortgage networks, they've got a lot more, for quite good reasons, sort of strict on what term we actually recommend. So we have to put a budget planner together for our clients, and it might not be the right thing for me to do, say, actually 25 years, off you go. Because that could be unaffordable to the client. Yeah. Even if the lender thinks it's affordable, the client, they know their finances better than we do. So 35 years to even 40 years now can be the norm. The longest term you can get is 40 years with most lenders. And lenders are going up to much higher ages to finish the term. So before, again, when I first started, we got to retirement age and that was about it. Then they started going to 70, then 75. Now there's some lenders that got to age 80.
Because people don't realise that the length of the term of the mortgage is dictated by your working clock, effectively.
Yes.
How long you can work for.
Yeah, so people are living and working longer. So that's why the mortgage lenders are much more happy to sort of go to age 75, 80.
Yeah.
And what a lot of people seem to think is that is fixed, set in stone for the whole mortgage term, which it's not. So, for example, your first mortgage might be a 35-year term. You're getting on the ladder, you're getting used to the payments, but you might have had a substantial pay rise in the first 2 or 5 years of your mortgage term. Your fixed rate comes to an end, and you've now got, say, 30 years remaining. But actually, a good mortgage advisor will say, let's not just keep that as is and just assume that's red. Let's look at your finances and be like, actually, you could afford to reduce this by, even if it's just 3 or 5 years, that will save you thousands in the long term in interest. So that's why we have really sort of careful conversations with clients when we review it each year or 2 years, is what's changed in your life? Have you had an increase in pay? Have you paid off that car loan? Or vice versa, like, oh, you've now got 2 kids, your payments have gone up quite a lot. Do you want us to look at, even if it's just a short period of time for the next 2 years, do you want me to increase your mortgage term just to help make those payments a bit more manageable? So it's a very flexible thing. You can review that at any point.
Yeah. People don't often think it's flexible.
No, they don't.
Do they? I didn't at the start. I was kind of like, right, 25 is what I'm in for, 25.
And that's it.
I've kind of done mortgages at different terms. I had a buy-to-let that I had a 17-year term on because I wanted it paid off by the time I turned 50 by the tenant. And then regulations came in the opposite, what we spoke about on the stress testing, to make it harder, which then meant I had to change it, I think, to 24 years at the time. Whereas my first family home that I bought, we did on 25 years. Then the second bigger family home with 2 kids, etc., we've done on 35 years, which was 5 years ago, I think. What I quite like about the 35-year term is I'm also able to overpay on the mortgage if I want to, which inadvertently is actually a safer kind of almost risk-free way of, if I don't want to overpay that year or that month, I can have the more affordable monthly rates. But if I did want to at the end of the year, if I was a business owner and I got dividends, for example, well, I can chip a bit of that off.
Yeah, the ball's in your court there,
and it kind of gives me the flexibility. I feel more in control of that term.
Yeah, most lenders let you overpay up to 10% of the loan amount each year, so it's quite substantial.
Yeah.
And if anyone's listening or watching and wants me to send it to them, I can. There's a few calculators out there that are really useful and really quite fascinating. So if you just overpay like £30 a month, £50 a month, what that will do in terms of reducing the amount of interest you pay, it's, if you look at compound interest, it's basically that in reverse in terms of what you're going to save. And there's some great graphs that I can send out to people to demonstrate that. And it's just having a little bit of discipline and just making some overpayments. Like you said, it doesn't mean it's set in stone, because by overpaying, you are reducing a term yourself. But if you want to go back to your original payment, you can do, and you haven't, financed the mortgage effectively.
Yeah, I think if you're due a remortgage in 2025, it's worth having a Zoom call with you just to kind of look at that, to work out your finances. Even if your remortgage is due in 9 months' time, 6 months' time, it's worth having that Zoom call to kind of look at, okay, what can we afford monthly? Because in a 35-year term, a decade on, a lot can happen. A lot can be different. You could go from, let's say you got it at 30 years old to 40 years old. You might be on a much higher salary. You might have kids. Interest rates might be different. You might need to move it up or down, but it's good to kind of know where you stand. So yeah, that fixed term. And then if you do earn loads more money 10 years down the line and you want to get that down to 20, and you've got 25 years left on it at that point, you want to actually get 5 years shaved off and pay a little bit more. When the fixed term comes to an end and you kind of do the remortgage, then you can obviously do that as well, which works. And
that's why it's really important, is work with your mortgage broker, make sure they know what your life and career goals are. It's like, look, Tom, I want to be retired and mortgage free by the time I'm 60, 55, not my state retirement age 68. I'm like, fine, that's good to know. I can help you get there. It's going to create some discipline on your side because I'm going to shorten this term for you, and your payments are going to be higher for the next few years, but this is what you'll save in the long term in interest, and I'll get you mortgage free by age of 60 or whatever. That's crucial information for us to know and helps you out massively in the long term.
Yeah, and for both of our industries, the property market is it's sort of hot topic. People are interested. Homeowners, you know, your home is your castle, as they say. But the landscape is moving so much month by month at the moment, which is why we do these videos. So if you're not following, in my case, the Avocado socials, or in your case, the Mortgage Tribe socials, we want to give back to our community of followers, and we will be regularly updating this information. So it's well worth following the socials just to keep tabs on what's going on, because you don't see it in the press, and the statistics that the BBC and Sky and places like that report on are normally land registry stats, which are like 6 months behind anyway. So these are the live updates, so definitely give us a follow. And yeah, it's great information, and we'll cover some more subjects next month on a similar video.
Sounds good, Ian.